Hello traders, this is Novice Trader. Thanks for visiting quicktrades.blogspot.com. The following is an introduction to options. Before I begin, all the things that you've heard about options, whether they be good or bad, true or false, let's just leave those all at the sidelines right now and just try to hone in on my presentation. Thank you. So a little background, I'm going to talk about what exactly they are, why they're amazing, some definitions so we're all on the same page, and from there the Greeks, and then how I do things. So, what exactly is an option? An option is a stock derivative that gives you the right to buy or sell a stock at a certain price. A single contract controls 100 shares, and it trades very similar to stock, as in they have bids and asks, and they can be traded, bought and sold within minutes, depending on the liquidity and things of that nature. And there are two types. We're just going to keep this basic. There's calls and there's puts. Calls are bullish, puts are bearish. So, why choose them? Well, first of all, and the part I like most, is you only can lose the price of the call or put. In the case of this, the last trade was $85, where my cursor is, or 85 cents, which is actually $85 because each contract equals 100 shares. So when you see a price, you multiply it times 100. Okay. But anyways, so at the most, you can only lose $85 per contract. So if I have two contracts, that would be $170. So number two, I like the leverage that they give you. As in this example, RDN had a great breakout today. It rose 22%. Well, at the same time, this call rose over 400%. That's 4 times whatever you bought it. I'm sure you're all aware of that. But the other calls in this same security rose 130, I believe, and 80%. So that's definitely more than the 22% that the actual stock gained. So I like that too. And lastly, it's something where my small account size can get in on stuff over $20, $30, $40. So with MGM and GE and things like that, where yeah, I could buy some shares but nothing significant, options make that possible. So some definitions so we're all on the same page. The strike. The strike is the exercise price, or the price that the person that is holding the call or put can buy the underlying stock at. ATM is an at the money option. That means that in the case of RDN, which trades at 14.52, or did its last trade, the call that's at or below that price is at the money. So this $15 call is not at the money. The $12.50 call is at the money because that's the closest to 14.50, because there's the $15 call and the $12.50 call. Let's take a peek. RDN. Yeah, so as we can see here, there's the 12.50, the 15, the 12.50, and the 10. So the $12 one is the one that's at the money. So the out of the money calls, those are the calls that are greater than that price. So that $15 call I just showed you, that's out of the money. ITM in the money is anything less than that. So that $10 call is in the money. And the expiration dates vary. They can go month to month. Some can go out to 2011, and they're always different.